Welcome to the October Market Thoughts video. My name is Maria Considine King, and I'm joined by Brad McMillan, Chief Investment Officer at Commonwealth Financial Network. Brad, as of midnight on September 30th, Congress failed to pass a budget that would prevent a government shutdown. What should investors expect to see in the fallout?
What happened this morning, really, is that we've moved into a policy-driven dispute that's not actually about the budget. As such, we don't have a resolution that we can actually point to. We don't know what will make this work. That's something the Republicans and Democrats have to determine on the fly. So the best we can do at this point is try and quantify what this means. Fortunately, we have some idea of how to quantify that. We can look at what spending is actually going to be cut back. We can look at history. And we can run various scenarios to say, okay, well, how much damage is going to be done depending on how long the shutdown lasts. At this point, assuming the shutdown doesn't last too long, the damage appears to be manageable. Probably on a par, if it's less than a month, with the sequester damage or less. This is not something that's particularly worrying. It's not good, but it's survivable. And that's what we need to look at, see how long it lasts and how much damage is going to be done.
At the same time, we have the debt ceiling debate. How do you expect that debate to be resolved?
That actually is the real problem here. We have been through shutdowns before. This is something that we don't want to see, as I said, but it's survivable. I'm not worried about it. The debt ceiling debate could result in much larger decreases in government spending, much larger immediate economic damage, and much larger potential going forward costs in the form of higher interest rates. Because of that, I don't actually expect it to happen. But certainly, being right now in the debt shutdown mode, that could be negative in that it could poison the atmosphere for those negotiations. On the other hand, it could also turn out to be positive in that it creates a sense of urgency in the congressional negotiators. We just don't know yet.
While Washington is unstable, there appears to be generally positive economic news out there. Durable goods sales and home sales are up in August, and unemployment claims are at a 6-year low. Does this give you reason to be optimistic?
I think there's no question that we are dealing from a position of relative strength here. No one wants this kind of situation with the government, but if we have to have it, going in from a relatively strong point of view in the real economy is the way to do it. We're seeing employment continue to surprise to the upside. We're seeing manufacturing continue to improve. We're seeing housing continue to do well. All of the fundamental drivers of the economy are doing quite well. Now the question is going to be, how much does this governmental uncertainty subtract from that? And for an example for that, we can look at the fourth quarter of last year with the fiscal cliff. Governmental uncertainty made people put off spending decisions. It made firms put off spending and hiring decisions. It took the growth level down to about 0. That is the downside risk right now.
And what should investors be particularly mindful of?
At this point, the fixed income markets have rallied. The Fed deciding not to taper, which was the big surprise of the month up until last night, meant that interest rates started ticking back down. So in fact, you've seen fixed income prices recover. And it suggests that the fixed income trade is not a one-way street. We've seen a lot of damage recently, but certainly the Fed is committed to keeping interest rates low, so maybe that sector is worth another look. On the other hand, rates will be going up sometime in the future, and we have to be mindful of that. We can't be assuming that things are going to continue well. On that same note, the assumption with the equity markets at this point seems to be that the government will indeed come to a deal. And I think that's a reasonable assumption, but investors need to be mindful of the risk should that turn out not to be the case.
Thank you, Brad.
Thank you, Maria.
And thank you. Please join us next month for the Market Thoughts video.